today we are diving deep in one of the most powerful and misunderstood force in the options trading, implied volatility, often referred to as an IV. Hey traders, welcome back to another session here at the Quant Quest Academy. I'm your host, Sarjoghian. Now, if you are ever bought or sold an options and notice its price swing up or down, even when the stock barely moves, then you are already felt the power of the implied volatility in action. But here is the kicker. Most new traders don't fully understand how IV works. And even experienced traders sometimes overlook how critical it is to options pricing risk and timing. So in this episode, we are going to break it all down: what implied volatility is, why it matters, how it affects the price of the options, how it changes with the events like earnings, and most importantly, how you can use it to your advantage in your trading strategies. So sit back, grab your notebook, and let's get into it. Let's begin at the core. Implied volatility is the market's expectation of how much the stock could move in the future. It's called implied because it's not based on the actual past movements. Instead, it's inferred from the current options prices. If the options on the stock are expensive, it tells us the traders believe something big might be coming. If they are cheap, it suggests that the market expects things to stay relatively calm. Implied volatility is expressed as a percentage. For example, 20%, 30%, 60%, and is annualized. A 30% IV suggests that the stock is expected to move up or down by about 30% over the next year. Now here's what's fascinating. IV doesn't predict the directions. A stock might go up or down. IV only tells us that the market expects movement. You might be wondering, where does this expectation comes from? It comes from the supply and the demand in the options market. If lots of people are buying options expecting a big move, price rises, and so does IV. If there is less demand, IV falls. Now let's get to the heart of it. Why does IV matter so much? Options have value because of two things: intrinsic value and the extrinsic value. Intrinsic value is the easy. It's how far in the money the option is. But intrinsic value, also called time value, is where IV plays a massive role. When implied volatility increases, the time value portion of an options increases too, meaning options premiums rise, even if the stock price doesn't move. When IV drops, options prices drops too. This can create some pretty frustrating scenario for the traders. Let's say you buy a call options and the stock goes up a little, but IV drops sharply. You might lose money on that trade because the falling IV shrinks the premium faster than the price increases, helps you. This is where Vega comes into play. Vega measures how sensitive an options price is to a 1% change in the implied volatility. So, if an option has a Vega of 0.15 and the IV drops by 5%, your options loses 75 cents in value, just from volatility alone. Alright, now that you understand what IV is, it's important to compare it to its cousin, historical volatility, or HV. Historical volatility measures how much the stock has actually moved over a given period, like 20 or 30 days. Traders compare the two to spot opportunities. When IV is higher than the HV, options are considered expensive, and that's usually a good time to sell options. When IV is lower than the HV, options may be undervalued, and that could be the smart time to buy. So when you hear someone says volatility is elevated, they meant IV is well above its historical average and that might indicate risk, opportunities, or both. Let's move on to the trades rite of passage, the earning trades. This is one of the most popular times for traders to buy or sell options, and it's where IV can play a huge role. Trading up to the earnings, IV typically rises. Why? Because nobody knows what is the earnings results will be. It could send the stock soaring or crashing. That uncertainty gets priced into the options, inflating the premiums. But here is the danger. Once the earnings are released, the uncertainty vanishes, and boom, IV collapses. This is known as the IV crash. So what does that mean for you? If you buy an options before earnings and the stock doesn't move enough, or even if it moves in your direction but not by a lot, the drop in the IV can cause a huge loss. This is one of the main reasons the new traders get burned on earnings plays. They didn't consider the IV and overpaid for the options. Even if they were directionally correct, they lost to the crash. Smart traders either avoid buying the options during the high IV events or using strategies that benefits from the falling IV, like iron condors, short straddle, or credit spreads. Let's now talk strategies. If implied volatility is high, you generally want to be a seller of the options. Why? Because premiums are inflated and IV is more likely to come down than go higher. That means strategies like selling cover calls, credit spread, iron condors, and naked puts. On the flip side, if implied volatility is low, options are relatively cheap. That's when you want to be a buyer, and use strategies include long calls or long puts, debit spread, or long straddle. But how do you know what's considered high or low? You can use tools like IV rank or IV percentile. IV rank shows where the current IV sits compared to the last year's range. If the IV rank is 80, that means the IV is higher than 80% of the past years. That's pretty elevated. Let's now explore the more advanced but powerful topics: volatility skew and the volatility surface. Skew refers to how implied volatility varies across the strike price. In equity options, put often have a higher IV than calls. This is due to the demand for the downside protections. But this skew creates opportunities, especially when constructing the spreads. The volatility surface adds another dimensions time. It looks at how IV changes across the strike and expirations. Some options might be overpriced in the near term, while longer dated options remains cheaper, or vice versa. If you are building multi-leg trades like calendars, diagonals, or ratio spreads, the surface helps you choose which expiration and the strike gives you the better edge. Professional options traders use this surface like a heat pump to spot mispriced options. But even if you are not trading professionally, being aware of this can help you avoid buying overpriced options and guide you in constructing the smart trades. Alright, let's wrap it all up with a quick summary and a few final thoughts. Implied volatility is the market's prediction of the future movement, not the direction. High IV inflates options premiums. Low IV means cheaper options. Vega tells you how sensitive your option is to change in IV. IV crash is real, especially after earnings or big events. Match your strategy to the IV environment. Sell high IV and buy low IV. Tools like IV rank and the volatility surface helps you assess opportunities. And here is the bonus tip. Always ask yourself, am I paying the fair price for these options? If IV is elevated, it better be for a good reason, or you might be walking into the trap. Understanding the implied volatility is super powerful in the options trading. It separates random guesses from the calculated risk. And now you are equipped with the knowledge to use it smartly. Thanks for sticking with me. If you found this video helpful, make sure to subscribe to Quant Quest Academy for more breakdowns like this. Drop the comments with your favorite IV strategies or any questions. I respond to as many as I could. Thanks for watching and see you in the next video.